Welcome back. We actually going to start with going through transaction and see how they apply to each different scenario. So again, I highly recommend using notebook for you, solve, and a pen just to follow along to make sure you understand how it works. After a while, you'll see a lot of transaction actually might be repeating themselves through the homework. Practice makes it perfect. So we're going to go through 4-step process as described before. Identify, analyze, record, and post each transaction. We start out with Fastforward received 30,000 cash from Chase Taylor as an owner contribution. So as far as business concerned, a cash went up by 30,000 and Taylor Capital went up by 30,000. In accounting, when the accounting equation used to analyze it, the actual journal entry would be recorded as debit to cash. Cash increased 30,000. Credit Taylor Capital, credit 30,000. Debits listed first, credit listed second, and debits equal credits after each transaction. So we went through first 3 processes. The next one, it would be posting to each individual account. So cash happens to be account 101. So as soon as I post this, and we're going to use T accounts for this example, but general ledger, long format, and T accounts are the same thing. You will not be doing both. You're going to be doing one or another. The 30,000 debit, we're going to put it exactly how we record it. So all the thinking takes place here. Here we're just sorting it, like what I mentioned as a grocery store example. You did your shopping, you made all your decisions, now you're just sorting into appropriate place. And then we're going to credit to capital account. Also, this number here, account number, would only appear here once posting have happened, right? So we don't put 101 here right away. We're only going to put it once we have done this recording. So I'm going to stop right here short and my work day is over and I left, the 301 should not be here till the next day I show up posted and 301 is here, right? So if somebody calls sick, if I see this, I know they already did this. If I don't see this blank, I know assignment, the transaction have not been posted. The second transaction. We're going to purchase supplies for cash. So in this case, cash is an asset, right? 2,500, and I'm paying it. So when we use cash, it's a credit. It reduces our asset, and supplies happens to be an asset is an increase. Remember, we post a debit first, so supplies going to go first because it's an increase under asset category. So supplies 2,500, credit cash 2,500, and again, I'm posting 2,500 under supplies account, and my cash account, I'm going to credit 2,500. Do you guys see how I accumulate each transaction? I still have my balance from previous one. This would help me to understand what is in each of my accounts. So when we post things, even though each general journal entry is going to be interdependent, when we post it, we're collecting data for each account. This way we know what we have at any given point of time. And third transaction, we purchase equipment for cash, 26,000. So we have equipment going up and cash is going down. So debit equipment for 26,000, it's an asset, and credit cash for 26,000, it's a decrease in asset account. We're going to increase our equipment account and we're going to decrease our cash account. And transaction 4, we have purchase supplies and credit. So when we have a credit, it's liability, and liability goes up with the credit. So I have to remember that. And supplies is an asset, it goes up with the debit. Again, I'm going to list my debit first. Increase in supplies of 7,100. Accounts payable gets increased as a credit 7,100. Under supplies category, I'm going to debit. I'm just posting it. We call it posted to the general ledger. This is your general ledger. 7,100, and then you're going to increase your accounts payable for 7,100. Transaction 5, we're going to provide service for cash. So 4,200, my equity, my consulting revenue goes up with a credit, and expenses actually go up with a debit. So just something to remember, but again, you can use your reference chart. So I'm getting paid cash, it goes up, debit 4,200, consulting revenue, credit 4,200. So I'm going to post increase in cash and increase in my revenue account. So in this case, the revenue is great, right? You made money, but credit is an increase for revenue. So there's no such a thing as debit bad or credit good and vice versa, because it's a different impact, depends on what side of equation it's on. In transaction 6, I'm going to pay an expense of cash of $1,000. So expenses are always a debit. So when I analyze transaction, back to what we've done before in the previous chapter, negative cash 1,000 and expense negative 1,000. It's actually, as far as expense goes, up, but it's a decrease to equity overall. So expenses are debited, normal balance for them, and cash is credited, decrease. We're going to post each specific item in each of the accounts. We have a payment of expense in cash. In this case, we pay $700 cash for employee salary. And this is where I say you're going to start seeing transaction looks similar. They're just changing the nature. So previous one was expense, this is expense. The same thing, different account, salary is expense, versus before we had rent expense, but entry keeps repeating themselves, just a different type of expense. So negative cash 700, salaries expense negative 700. So we're going to debit salaries expense, credit cash. So in this case, we're going to post it in salary expense. It's a very first account, and cash account. We keep accumulating. We keep collecting what's going on in the cash account, that information. We're going to provide consulting and rental services, but in this case on credit. When we see word credit, it means accounts receivable. It would be received later. So accounts receivable and asset, it goes up, and both revenue accounts go up as well. In this case, we have 3 accounts. So remember we said we need at least 2, but you can have 3, 4, 5 accounts. So you're going to debit 1,900 and credits follow the debit. And the total should be equal once you're done. And after that, you post in each individual account. You can stop and redo this problem or write it out as I go along to make sure that you understand the process of it before you jump into the homework. Receive a cash on account. So Fastforward received 1,900 cash from the client billed back in transaction 8. Remember, we cannot recognize revenue when we receive cash again, just because that would be double counting the revenue. It's between accounts receivable account and cash. So in this case, cash went up by 1,900 and accounts receivable went down by 1,900. So cash debit 1,900 and credit 1,900. Partial payment on accounts payable. So we actually going to pay $900 for supply. We don't have to pay full amount. We might have a payment agreement with them and so on. So each time we make a payment, we're going to account only for the portion we paid. So word paid implies cash, so negative 900, and accounts payable being decreased. Decrease in liability actually is a debit. So we list the debits first, accounts payable debit, and we are crediting cash. So an accounts payable account, this is the supplies that we purchased before, 7,100, but in this transaction, we're posting 900 payment received. The same thing with cash, we're going to decrease by $900. Withdrawal of cash by the owner. Withdrawal of cash by the owner is not an expense, so cash teller withdraw $200 cash from Fastforward for personal use. So we're decreasing cash of $200, and withdrawal is part of the equity is a decrease. So debit withdrawal and credit cash to reflect our debits and credits. Again, you always have to have at least 2 accounts. We post everything in the required account. Receive of cash for future services. So this is something I mentioned in a video 1. When we receive money for something that we have not provided yet, we cannot recognize revenue. By definition, we recognize revenue when it's occurred. So in this case, we have an option to book a liability, and then when we perform the services, we can then go back and reduce our liability and recognize the revenue. So we receive $3,000 cash, and under liability, we're gonna create account unearned consulting revenue. So accepting $3,000 cash obligation for Fastforward is to perform future services and liabilities is no revenue is earned until services are provided. They can call and say, we change our mind, and you have to send the money back. So we're going to debit cash and credit unearned service revenue or consulting revenue. So in this case, cash go up by 3,000, and unearned consulting revenue also went up by 3,000. The ability, when it's a credit, we call it going up or increase. Pay cash for future insurance coverage. I mentioned that one as well. We have a prepaid insurance. So we're going to increase our asset of prepaid insurance, and we're going to decrease cash that we just paid. So we're going to increase, which is a debit, asset prepaid insurance, and credit cash for making the payment. And we're going to post each of them individually. And I'm keep clipping my PowerPoint. Okay. Now, Fastforward pays $120 cash for supplies. It's between two assets account. So we pay cash $120, and we get supplies as an asset of $120. So our supply account went up and our cash account went down. We have a payment of expense in cash. So Fastforward pays $305 cash for December utilities expense. We have seen this before, right? With rent, with a salary. So we recognize expense. Expense is a debit. Credit cash, $305 is a decrease. So you can see some of those entries are repeating themselves, different nature. The concept is the same in terms of how we treat expenses, revenue, and so on. So you'll see the pattern. The same thing with salaries expense. When we pay salaries expense, we're going to debit expense, credit cash, and post it in corresponding accounts. So now we're done with all our transactions, and everything we put in the general ledger. This is called general ledger, and this is a T accounts format. We're going to add all our debits, we're going to add all our credits, and whoever wins, right, we're going to put on that side just the one number. Your shareholders don't need to know day-to-day detail. They just want to see what you have in each account. So some accounts would have a lot of activity, some would have less. For example, accounts receivable, you already paid, you've been paid already by your customer, so balance is zero. So things did happen, but at the end of the day, it's a zero. That's all they need to know. So each of those totals is going to go to my trial balance. And this is where we're going to talk about trial balance. When we prepare trial balance, we list each account title and its amount from the ledger in the trial balance. An account has a zero balance, we usually don't put them. And they listed under normal balance. Remember, normal balance where the account increases. For assets, for example, it's a debit. For liabilities, it's a credit. Then we're going to compute the total of debit balance and the total of credit balance. Verify proof that total debit balance equal to your credit balances. Okay, so we have two, this is a summary of everything we have in each account in this previous slide. So you have cash, this is all normal balance, right? All assets, liabilities, normal balance is a credit. Capital account is normal balance is a credit. Withdrawal and expenses have the same treatment. So if we look at a debit and if we look at a credit, we have our totals, right, equal. So if you did everything in double entry, each of them, this would be true by the time you get to this process. So the trial balances list all ledger accounts and their balances at the point of time. So in this case, it's December 31st, 2019. And if the books are in balance, the total debit will always equal our credit. Okay. Nothing is perfect. We could have some errors, and it happens all the time. This is busy human and error kind of world. And if you don't make any errors, that's amazing. Even people can enter things wrong in computer and then balances will come out. Some softwares would actually stop you if your debits don't equal credits, but you can reverse things incorrectly. So a couple things you want to make sure. Make sure the trial balance and columns are correctly added. Make sure accounts balances are correctly entered from the ledger, right? See if the debit or credit accounts are mistakenly placed in the trial balance or you have reversed them. Recompute each account balance in the ledger. Verify each journal entry posted correctly. So remember, if I put cash debit, it has to make it as a debit into my ledger when I'm posting it. And verify that each original journal entry has an equal debit and credit. So this is a good way to be able to check yourself. So after you're done with your trial balance, you can prepare financial statements. In the next topic, not in this chapter, we're actually going to do adjusting entry. So you really prepare your financial statements from adjusted trial balance. So we have unadjusted trial balance, which we just created, and then we're going to learn that there's more entries that we made, and then we have adjusted trial balance. But once you're done with your information with your trial balance, you can prepare your income statement, statement of owner's equity, statement of cash flow, and ending balance sheet. Okay, so those statements we look at a period of time, as of end of a year, as end of a quarter. The balance sheet is a certain point of time when we prepare them. This is a little bit of review, but we're going to make sure that we understand this stuff is going to keep coming up, and you need to be very strong that you understand what goes in each financial statements and how we prepare them, because the best user knows where numbers come from. So we have income statement reports revenue less expenses incurred during the business period of time. Statement owners, we start with the beginning balance plus any income or loss that we made during the year, plus any investments owners made, less any withdrawn over a period of time. And then we take this number and we put this number into balance sheet, either ending owner's equity. And statement of cash flow explains your balance from beginning of a year to the end of a year. And again, you need to understand what statement of cash flow means, but we're not going to quite prepare it yet. All right, so if I take my data from a previous information that I give you guys the trial balance, we can take our accounts and build our financial statements. And I'm quickly going to go through it. So I'm using this data right here, this final numbers and the trial balance. 4,275, 9,720, all of those numbers. So this number's up to this point, right? It's going to be my balance sheet account. These numbers are part of my income statement, revenue and expenses. And this numbers right here, right, the beginning capital or investments plus your withdraw are going to be used for owner's equity. So I'm going to travel forward, not to make you guys too busy. And we're going to build a financial statement. So you always have a name of a company, the statement you're presenting, and the time period it's for. You're going to list your revenues. Then we create a total. So one line means a subtotal for the final number. We're going to list our expenses, and we have total expenses. By the way, this is not debit and credit. This is not left and right column. All it is cosmetic to push numbers to the right just for you to see, oh, total revenue 6,100. Total expenses, 2,705. Oh, what does expenses consist of? You can visually move here and see detail where expenses went on. Now, your revenue minus your expenses equal net income. If you need to pause the video and recalculate it, this is your chance. Okay, once you have net income, we're going to need this data to go into our owner's equity. So we start out beginning balance. It's a brand new business. We started with nothing. We invested 30,000. That was our first entry, actually. It would be given to you, but you have to remember what happened and be careful. You're going to add net income you just calculated. So you have net increase of 33,395, less withdrawal from owner, and your ending capital is 33,195. This number is going to be used on the balance sheet to finish your financial statement preparation for this particular exercise. So remember how on a trial balance, I mentioned all of those going to be used on the balance sheet. So here we are, all our assets. And remember, your assets are not in any other financial statement. They're not on an income statement. They're not on owner's equity. They're just here. So accounts really get used only once. What you're really doing, you're trickling those numbers from previous financial statements. They roll into each other, but you're not using accounts over and over again. So you have all your assets in here, then you have your liabilities and your total equity. So asset equal liabilities plus owner's equity should have come up the same, and you're done with your balance sheet. All right, so make sure this is secure. We're going to keep practicing this over and over again. We're doing transaction, but this is a full process. We're not done with the all accounting cycle, but this is a process of life of our accounting transaction. Couple presentation issues that I want to mention. This is a good time to do that. Dollar signs are not used on journals and ledgers. We usually don't do that. Dollar signs appear in financial statements, but a lot of times they'll be like in the beginning or ending number. So put dollar signs besides only the first and last number in a column. When amounts are entered in a journal ledger or trial balance, commas are optional to indicate thousands, millions, and so forth. A lot of people use Excel. Highly recommended if you're very handy with that. But again, you don't have to do that. But if it helps you to add things up, it's important. Comma are always used in financial statements. And companies commonly round amount and report to the nearest dollar or even higher, so millions, thousands. And when we're going to do our last topic, we're going to look at financial statement analysis later in the financial accounting learning process. You'll see that sometimes they report it in thousands or even millions if company has a big revenues and so on. All right, we are on to our last learning objective. We're going to look at how to compute debt ratio and describe use of analyzing financial conditions. So debt ratio is a total liabilities divided by total assets. So little by little, we're going to see or try to appreciate what those numbers mean, because those numbers talk to a third party or internal users to give you good business information to be able to decide how you should pursue and how you should run your business. So when we do debt ratio, we evaluate the level of risk, how risky the company is. The higher the ratio indicate there is a greater probability the company will not be able to pay its debt. So if you have a high level of liability to relationship to your assets, that is a higher risk. So this is a couple years ago, but this is Walmart debt ratio, and you can see their debt ratio current year is actually a little bit higher. You wouldn't worry about it as much, 1%, 0.1 difference of it, but you can start comparing companies with different size among each other. So this particular company, right, compared to Walmart has a higher debt ratio, so they have a higher probability. It also means they have 70 cents of liability, total liability to each dollar of asset they have. So if that number goes above 1, that means you have more liabilities than assets. That could be a problem. And each particular company would actually have different standards. Like manufacturing might have a different version of what the expectation